Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, I'm Michelle and welcome to Through the Noise podcast. Over the past week, we have seen some major events happening globally. The US have kickstarted their Q3 earnings season, and the ECB has also lowered their policy rate for the third time of the year. Meanwhile, in Asia, we also see China announcing a series of fiscal and housing stimulus to drive economic growth. As we move into critical weeks ahead of the US presidential election and China's PRC meeting, how should we weather across the current market conditions? To discuss this more, I'm happy to be joined by Rajat Bhattacharya, our senior investment strategist here at the CIO office. Hi, Rajat. As we all know that the US election are less than 3 weeks away, how is the race shaping up?
Hi, Michelle. Thanks for having me. The race for the White House remains very tight, and we can see that in the average poll of polls by independent houses, such as Real Clear Politics, something we track closely. While a lot could change in the next 3 weeks going into the elections, historically, the incumbent party wins the US presidential election if a recession is avoided. Now, this is important. Since there is no sign of a recession currently in the US, the Democrat candidate Kamala Harris probably has a slight edge going into the 5th November elections. However, I must say that the betting markets are indicating Republican candidate and former President Donald Trump has been gaining momentum in recent weeks, with a widening gap versus Harris in the race to the White House. Now, whichever party wins the White House is also likely to win control of the US House of Representatives, given similar voting constituents. Also, Republicans have a greater chance of getting back control of the US Senate, according to the polls. These indicators imply a rising chance of a Republican so called clean sweep of the White House and both houses of the US Congress. However, I must warn that the probability of a Republican clean sweep is still below 50%.
Got it. So against this backdrop, what is the implications for market for now?
So the implications is that while the election is still close to call, a Republican clean sweep is probably the most supportive scenario for US risk assets, given Trump's agenda involving tax cuts, deregulation, and import tariffs. However, such an outcome would clearly be negative for non US equities and US bonds, given the likely tariffs to be imposed on China as well as other US allies, and the inflationary impact of immigration curbs and higher budget deficits. Given this, some of the ways to position for a Republican clean sweep would be to buy the US dollar and gold and stay overweight US equities. Within US equities, we could see a preference for the following sectors in case of a Trump win and a clean sweep. One, small caps, which could benefit from tariff protection. Second, US financials, which could benefit from the potentially higher for longer interest rates and deregulation. And then you have the US energy sector, given Trump's preference for fossil fuels. And finally, the aerospace and defense sectors. Now, the alternative outcome of a Harris victory with a divided Congress would be business as usual in the US and relieve geopolitical uncertainty. It would also lift non US equities and currencies given the lower geopolitical risks. And by non US equities and currencies, we particularly could see China and emerging markets benefit from that outcome. Chances of further Fed rate cuts in this scenario would also be positive for gold. So you can see uh, gold stands to benefit from both outcomes.
Got it. So let's move over from the US politics to now US businesses. So how are the Q3 earnings looking? And on top of that, we also see some latest pullback in some technology sector stocks. What is our outlook on this sector?
Sure. So far, around 13% of the S&P 500 companies have reported Q3 earnings as of yesterday, which is 17th October, with an overall positive earnings surprise of 6.5%. Within that, the financials have led with an earnings surprise of almost 11% amid upbeat earnings from major US banks. This is followed by sectors including consumer discretionary, communication services, while on the other side, the energy and industrials have been the lagging sectors, reporting earnings misses. Now, overall, we retain a barbell approach to US equities in light of the potential market volatility heading into the elections. We favor growth sectors on the one hand, including technology and communication services, alongside financials and healthcare to provide resilient earnings. We believe the broader sell off in the global technology sector early in the week largely boiled down to uncertainties in the US earnings season, and second, the potential US restrictions on semiconductors chip sales. Having said that, we see opportunities to add exposure to the sector on dips as rising adoption of artificial intelligence and the development of AI digital hardware continue to support longer term secular demand for semiconductors. Earnings forecast for both the technology and communication services sectors at about 21% and around 17% in 2025, respectively, exceed the broad S&P 500 growth estimate of almost 15%. Now, the upcoming earnings reports will be keenly scrutinized. We'll be
Got it. So let's shift our focus from the US back to China. We've noticed that policymakers have unveiled some further stimulus measures. So, what are they, and do you expect those measures to improve growth or risk sentiment?
Yes, we've seen another heavy week for policymaking in China. So, China announced plans to recapitalize local government finances and large banks, while also allowing local governments to use proceeds from bond sales to buy unsold homes to revive the troubled property sector. Separately, the Housing Ministry announced an expansion of credit support to revive the property sector to the tune of almost 4 trillion renminbi, which fell short of investor expectations, I must say. More details of the bond issuance plans are likely to be unveiled after the National People's Congress Standing Committee meeting later this month. Now, the package suggests a rebound in government spending in the coming quarters, thus putting a floor under 2024 and 2025 growth estimates. Remember that fiscal spending fell sharply, fell almost 3% year on year in the first 8 months of the year. So, any new fiscal stimulus is going to only improve and upscale those fiscal stimulus going forward. Other measures to revive the stock market also significantly reduces downside risks to China equities, in our view. Nevertheless, a sustained rebound in China's economic growth and equities would likely require additional fiscal spending and bond issuance equal to at least 10 percentage point of GDP over the next 3 years. Until such spending commitments are made, China equities are likely to trade within our base case range of around 20,000 to 22,500 for the Hang Seng Index.
Got it. So finally, we can see that the ECB actually cut rates for the third time of the year earlier this week. So, what are the key takeaways from the ECB's rate decision, and what is the impact on the European government bonds and also the euro?
Yes, indeed. The ECB delivered that 25 basis points rate cut that the markets were expecting, with recent economic data from the euro area highlighting persistent economic challenges as well as falling inflation. So, the latest figures show that euro area GDP growth remains sluggish, with Germany facing ongoing industrial weakness. Euro area inflation has slowed, with headline inflation now below 2%. Since the end of September, the euro dollar has retraced from 1.12 to the current spot of around 1.08, indicating an oversold condition. And this is primarily because of the weaker data as well as the suboptimal inflation data that came through. Now, we expect to see a technical rebound from here. Also, there may be some profit taking in the short euro dollar positions before the US election. Technically, We see support around 1.077 and resistance at 1.114, followed by 1.121 for the next 2 weeks. We also remain bullish on the European government bonds, anticipating that the ECB will cut rates further, although President Lagarde was relatively sanguine. The initial French budget proposed last week, which targeted to cut national deficits aggressively, suggests near term volatility could be high. We would use any such spike in interest rates to add exposure to the European government bonds.
Thank you so much, Rajat, for the engaging discussion. So, in summary, ahead of the US presidential election, we still retain a barbell approach in the US equities. We favor growth sectors like technology and communication services, alongside financials and healthcare to provide some resilient earnings. Meanwhile, we remain bullish on European government bonds to anticipate that the ECB might cut rates further. And we also expect Chinese equities to trade within our base case range of 20,000 to 22,500 points for our Hang Seng Index. And we also await additional fiscal spending from China to support a sustained rally in the equity market. So thank you so much for listeners for listening from the start to end. And with that, we'll close off this week's Through the Noise podcast. See you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.